Yes, I want us to proceed from our previous discussion. So we were looking at financial statement analysis. Financial statements analysis. So that is the topic we were looking at. So we looked at two areas under financial statement analysis, whereby we looked at comparative analysis and common size statement analysis. Common size statement analysis. And we looked at the illustrations pertaining to the two, how you can actually end up having to go about, in this case, what comparative analysis and common size analysis. So ideally, what we said that financial statements are made or are prepared to enable make decisions within what organizations. So when you come up with an income statement, when you come up with a statement of financial position, we would like to use these financial statements to make decisions, And majorly, these decisions will likely be made by those in management. So before they make the decisions, they'll be able to do what we call an analysis. So this analysis will enable them to have like a better understanding about what their financial statements. So whereby in this case, if you look at maybe the common size statement, we are converting the items in the financial statements into percentages. So you're likely to do an easy analysis when you have like a percentage, or a percentage of those elements can be able to give you like a kind of like a trend as to what is happening. So when you do the comparative analysis, for example, you can be able to know what was maybe the growth in terms of sales from the previous year to the current year, from the previous year to the current year. So this analysis just helps in having to enable those who are making decisions to be able to try and actually make informed decisions. So it helps in having to enable them to make what we call informed decisions. So we looked at, in this case, comparative analysis and of course common size statement analysis. So under common size statement analysis, we looked at vertical and horizontal. Vertical and horizontal. And of course, we saw how in this case you can actually end up having to present a vertical common size statement and a horizontal common size statement. So today, I want us, in this case, we look at ratio analysis. So this is far much familiar to you because you covered it in your financial accounting. So in this case, still, we can use what we call the ratio analysis to do analysis of financial statements. Ideally, what happens here in simple terms, you're having to present the elements in the financial statements in ratios. You're having to present them in ratios, whereby you do a comparison of two elements of the financial statements and be able to understand this item or a particular item is having to be represented how many times by another item. So through this kind of ratios, then also those who are making decisions can easily be able to have like a better preview or understanding of the financial statements as they make the decisions. And of course, you're going to look at different ratios and which kind of decisions can be derived from those kind of ratios, or what is the importance of having to formulate such kind of ratios whenever, in this case, we're having to do analysis of financial statements, of financial statements. So we can now, in this case, write ratio analysis, because that is what I want us to look at, ratio analysis. We can now write ratio analysis. Then we look at the different types of ratios. We can look at the different types of ratios and the formulas before we look at an illustration. So the different kind of ratios and the formulas before we look at an illustration. So you can write, in this case, ratio analysis. So you can just be able to write, this is the presentation. So it is the presentation. This is the presentation of financial statements elements. This is the presentation of financial statement elements by use of ratios. This is the presentation of financial statement elements by use of ratios. So then you can be able to say this comparison brings about this comparison brings about different types of ratios, brings about different types of ratios. This comparison brings about different types of ratios, which include, then you put a semicolon. So you can be able to list them here, the types of ratios. You can be able to list them there, the types of ratios. So these types of ratios will likely include, in this case, we can talk about profitability ratios. We can talk about liquidity ratios, or in this case, liquidity ratios. Liquidity ratios. We can talk about valuation ratios, or investor or valuation ratios, Then we can talk about, in this case, also activity ratios, or before activity, we can talk about gearing or leverage ratios. Then you have, in this case, activity ratios, or we can say efficiency, or asset utilization ratios, So we can have, in this case, these ratios. There are a number of ratios. There are so many. But we can be able to categorize them as profitability ratios, as liquidity ratios, as investor or valuation ratios, as gearing or leverage ratios, or in this case, activity or efficiency or asset utilization ratios. So those are the types of ratios we can actually be able to have. So I want us to look at each and every category, and now in this case, we look at the different classifications of ratios under each and every type. So we can start by having to look at what are the profitability ratios. That we can be able to have. What are the profitability ratios we can be able to have? So we can start with the first one, profitability ratios. Profitability ratios. And of course, now in this case, I want us, we put like a table so that we look at the ratio, the formula, and in this case, maybe a brief explanation about it. So you can start in this case by looking at profitability ratios. So the first category is category number one that we are looking at is profitability ratios. We can look at the formulas so that when we look at a question, you can be able to know which formula do you use. So you can put the type. Type of the ratio. You can put the type, or you can say not type, but you can say classification. And say classification. Then you can say the formula. You can put the formula. You can put the formula. Then you can put such kind of a table. So the first ratio here, it is number one. We have, in this case, gross profit margin. Then in this case, we have net profit margin. We can have net profit margin, but just write the formula first of all. So in this case, this one, you take the gross profit. You divide by the sales. You multiply by 100%. So in this case, it will be expressed in a percentage. So you'll go to the income statement, you look at what is the GP, gross profit, you divide by the sales, you multiply by 100%. Then another profitability ratio we can be able to have in this case, it is net profit margin. So net profit margin. So since here we are using gross profit, so automatically here we are using net profit. So it will be net profit. It will be net profit. You divide by, in this case, by the sales. You multiply by 100%. So that is the formula. So that is the formula for net profit margin. Then you have, in this case, operating profit margin. So we have operating profit margin. The operating profit margin ratio. Operating profit margin ratio. So this one is operating. Hope you're able to see it. This one is operating. So we have operating profit margin ratio. So operating profit margin ratio. So this one, you take the earnings before interest and tax, you divide by, in this case, the sales. You divide by the sales, you multiply by 100%. You multiply by 100%. The earnings you have before you deduct interest and tax. The earnings you have before you deduct interest and tax. You divide by the sales, you multiply by 100%. It'll be able to give you the operating profit margin. Operating profit margin. Then we can also have another one we refer to as operating expense ratio. Operating expense ratio. So we have, in this case, operating expense ratio. So this one, the formula you'll be able to utilize here, you'll end up having to just consider only what the operating expenses. You just consider only what the operating expenses. So you divide by the sales, you multiply by 100%. So it means, in this case, you'll take the total expenses. You'll take the total expenses. You deduct, in this case, interest expense. You deduct interest expense. Then you divide by the sales. Then you multiply by 100%. So you can see all the ratios here are actually presented as a percentage. So this one, you'll get your total expenses that you have. You less the interest expense. Interest expense is that, like the one in this case we learned, under borrowing costs. So the expense you incur in terms of what interest. Maybe you borrowed a loan, or you are looking for financing. So in this case, you are charged an interest, you've been paying it. If you less the interest expenses, and you only, in this case, consider what operating expenses. Operating expenses simply means, in this case, this kind of expenses are just incurred for operations. So you'll have to eliminate, in this case, what? The interest expense from the total expenses to get only the operating expenses. Then you divide by the sales, you multiply by 100%. So these are the profitability ratios. The profitability ratios. I can see you're asking about, in this case, what? Depreciation. So this is the formula. So don't bring in depreciation. So just eliminate only the interest expense. Just eliminate only the interest, not depreciation. Don't eliminate depreciation. So eliminate only the interest expense. So so those are some of the profitability ratios we can be able to have. So you can write something briefly about, in this case, profitability ratios before we move to the next types of ratios. So these are actually, this particular classification here, it is profitability ratios in relation to, in this case, what? Sales. So we still have others. So just put, in this case, can put something like that. So these are in relation to sales. These are profitability ratios in relation to sales. So you can see all of them, the factor here is actually sales. So these are the profitability ratios in relation to sales, But now in this case, we have another category of profitability ratios. We have another category. Hope you through with writing this one. So I want us to move to another category of profitability ratios. So just continue with your table. Just continue with your table. Just continue with your table. So don't erase your table, but you can continue with it in your book. You can continue with it in your book. So I think it will be number 5. Number 5, another profitability ratio, but it will be under a different categorization, which I'll be able to tell you. So in this case, we can have, in this case, return on investment. So return on investment, or you can say return on total assets. Return on total assets, or we can say return on total assets. So what is the formula here? So sometimes we refer to it as ROE. So you might see somewhere they have said ROE, return on investment. If you see ROE, they mean return on investment, or in this case, we can say return on total assets. See, it's just simply the return you're having to get from the business in comparison to your total assets. So what happens here, you'll take the net profits. You'll take the net profit you've earned. Net profits you've earned. You divide by, in this case, the total assets. You divide by, in this case, the total assets. You divide by the total assets. You multiply by 100%. You multiply by 100%. So you'll be able to get what is your return in terms of profit in comparison to your total assets. In comparison to your total assets. Sometimes this one, you might see somewhere they have given you it, ukula. This it simply means earnings after tax. So if you go to the income statement, you'll see this figure of earnings after tax is the one you'll be able to take as now that figure you divide by the total assets, you multiply by 100%. Or maybe they would be able to give you the net profit. So long as the net profit or the earnings after tax, those figures are correct, then you can be able to divide by the total assets, then you multiply by 100%. You multiply by 100%. So that is the formula. So that is the formula as to how you come up with the ROE, or return on investment. The return you're having to get from the business, if you compare with how much you've been able to invest in in assets. Remember, in this case, the assets you're investing in them. You've bought land, you've bought machineries. So these machineries you've acquired, are they bringing in a return? You compare the kind of profit you are making when you're utilizing these assets to know what is a return on what you've invested. Because when you buy the assets, you are investing into the business. You are investing into the business by acquiring the assets. So what is the return you're having on the assets? So it will indicate what? The utilization, it will indicate, maybe you can briefly write something here. It will indicate the return on utilization of assets. It will indicate the return on utilization of assets, So then in this case, we can have another one. So number 6, so it will indicate the return on how you're utilizing your assets, on utilization of your assets. Then you can have, in this case, return on equity. Return on equity. So what is the return you're having to get on what you've put in as equity? What is the return you're having to get on what you've put in as equity? So you'll take, sometimes it is written like this, ROE. You might see ROE, return on equity. This one is ROE, return on investment. So return on equity. So what is the return you are getting on what you've put in as equity? Equity is the capital component in a company. The capital component in a company. It can be made up of ordinary share capital, or maybe preference share capital, or other forms of of capital. So in this case, you'll be able to take net profits. You'll be able to take net profits, or in this case, it means earnings after tax. Then you divide, in this case, by the total equity. You divide by the total equity, or you divide by equity. Then you multiply by 100%. 100%, you multiply by 100%. So you'll be able to know what is the return you are getting on the equity you put into the company. Equity you put into the company. Equity you put into the company. So it will indicate the return on utilization of what? Of shareholders' funds. It will indicate the return. You can be able to write something small. It will indicate just the same case like here. It will indicate the return on utilization of shareholders' funds. It will indicate the return on utilization of the shareholders' funds. So it will indicate the return on utilization of the shareholders' funds. So equity is the shareholders' funds. So it can be preference shares that were sold. It can be ordinary shares that were actually sold. So it will indicate the return on utilization of shareholders' funds. Shareholders' funds. Then we can have return on net assets. Return on net assets. Return on net assets. Return on net assets. The return on net assets. The return on net assets, you can look at the last one there. Return on net assets. Return on net assets. So that is number 7. So that is number 7. So another profitability ratio, return on net assets. Return on net assets. Return on net assets, or sometimes we say capital employed. Return on capital employed. Capital employed. Return on capital employed. Return on capital employed. So this one you'll take the net profit. Sometimes it is known as ROCE. ROCE like this. ROCE. So ROS. It is known as ROS. It is known as ROS. So this one, just the same case, you take the net profit. You take the net profit. Net profit. You divide by, in this case, the capital employed. Capital employed. Capital employed. You multiply by 100. Okay, this capital employed is what you're having to call what? Net assets. So you can say capital employed or the net, you divide by the net assets. Net assets. So take note that in this case, you can be able to write an NB down there. You can be able to write an NB down there. I can see Nekesa says I'm breaking. I don't know whether the others are experiencing the same. Nekesa was saying there was breaking. I don't know whether the others are experiencing the same. Are the others experiencing the same? We are okay. We are okay. Elkana says we are okay. So take note that in this case, you can be able to write NB. So how do you get this capital employed? How do you get the capital employed? Who can be able to tell us? Who can be able to tell us how you get the capital employed or the net assets? How do you get the capital employed or the net assets? How do you get the capital employed or the net assets? How do you get the capital employed or the net assets? How do you get the capital employed or the net assets? Video quality is not good. So Clayton, you're not able to see the board or what? You're not able to see the board or what? I can see Elkana says total net assets minus current liabilities. Total net assets minus current liabilities. So you'll take the total assets. So capital employed is equals to capital employed. Capital employed is equals to the total assets. Total assets minus total liabilities. So the total assets minus total liabilities, that is the capital employed. So ideally, you'll likely be getting the capital component in the balance sheet. You'll be getting the capital components in the balance sheet. So you'll be able to, in this case, take the total assets you are having, you minus the total liabilities. You'll get the capital that has actually been employed. The capital that has actually been employed in the business. The capital that has actually been employed in the business. So that is how you get the net assets. You take the total assets, you minus the total liabilities. Then that figure you'll be able to get You, in this case, take net profit, you divide by it. Ideally, what you are getting, it is the capital element in the balance sheet. It is the capital element in the balance sheet. Because now in this case, the accounting equation is what? The accounting equation is total assets is equals to capital plus total liabilities. So to get this capital, this one crosses, it will be total assets minus total liabilities. So that's how you'll be able to get how much capital was employed in the business. How much capital was employed in the business. Take note that in this case, for the previous one, in this case, ROE, we are taking the funds for the shareholders. Because what happens with capital, you know, in this case, you'll see in the balance sheet they have indicated under equity, capital and equity, they'll be able to indicate, maybe in this case, we have ordinary share capital. They'll indicate in this case, we have preference share capital. They'll indicate in this case, we have maybe, what else can they be able to indicate? Maybe in this case, we have maybe debentures. We can be able to have in this case, maybe debentures, or in this case, they can be able to talk about share premium. They can talk about share premium. Share premium, they can talk about reserves. They can talk about reserves. So these are, let's assume these are the 4 elements in the balance sheet. These are the 4 elements in the balance sheet. So of course, these 2 components will be equity, will be part of equity, will be part of equity. But now capital employed will be all of them, will be all of them. So the figure for capital employed will be different because they'll be considering all the elements in this case in terms of the capital that was utilized in the company. But in this case, for the equity part, they just take what the shareholders put in as funds, what the shareholders put in as funds, what the shareholders put in as funds. So take note that in this case, when you talk about the capital employed, we are ideally talking about the capital component in the balance sheet. That's why in this case, we are taking the total assets minus the total liabilities. For the previous one where we are talking about return on equity, we are only considering the shareholders' funds. The shareholders' funds here were contributed by selling ordinary shares and selling preference shares. So the figure will only basically go up to this extent. But if it is capital employed, we take all of them, or ideally, we use that formula because we'll have liabilities here and the assets here. We take the total assets, we minus these liabilities, we'll be able to get this particular component. And of course, that is what you use in this case in having to do what? Compute return on net assets or return on capital employed. Return on capital employed. Return on capital employed. Return on capital employed. So what does it indicate? You can briefly just write what this formula actually, this particular ratio actually indicates. It indicates the percentage return from utilization of net assets. It indicates the percentage return from utilization of net assets. It indicates the percentage return from utilization of net assets. Utilization of net assets. So these particular ratios, we've just looked at them, the 3 of them from number 5, sorry, 5, 6, and 7. Remember the previous ones were in relation to what? To sales. The previous ones were in relation to sales. So these ones are actually in relation to what we put in as investment. These ones are in relation to investment that has been put in. These ones are in relation to these profitability ratios. The number 5, 6, and 7, the 3 of them are in relation to what? To investment. What we've been able to invest in, what we've been able to put in as capital, what we've been able to put in as total assets. So they're in relation to what? To investment. They are in relation to investment. They are in relation to investment. They are in relation. So they are in relation to investment, in relation to investment. They are in relation to investment, the 3 of them. So those are the profitability ratios that we can be able to compute or come up with. So I want us to look at another category of ratios. Let's look at another category of ratios. So let's look at another category of ratios. So in this case, we can go to the other classification. We can look at liquidity. We can look at liquidity ratios. Let's look at liquidity ratios. Liquidity ratios. How liquid is the company? How liquid is the company? We can look at number 2 type, liquidity. Liquidity ratios. Liquidity ratios. So you can put the classification of the ratio. Classification of the ratio. Then, of course, we can put the formula. Put the formula. We can put the formula. So the first, liquidity ratios. So these ratios are actually utilized in terms of having to determine how liquid the company is. What do you mean by how liquid the company is? We are trying to find out how long can the company end up having to take to settle either its short-term liabilities or maybe long-term liabilities. So how long can the company end up having to take to settle its short-term or maybe long-term liabilities? So, and in this case, it is so much of having to compare what are, like in this case, your current assets, and of course, what are maybe in this case, your current what liabilities. So in this case, when you compare the two, probably in this case, you can be able to know how effective will you be in terms of having to settle short-term liabilities. So you have a lot of money to be able to settle short-term liabilities. So in this case, you have what we call what current ratio. So the first one here, it is the current ratio. Current ratio. The current ratio. So for the current ratio here, you'll be able to, in this case, take the current assets, the formula, current assets, you divide by the current liabilities. You divide by the current liabilities. So the current assets, you divide by the current liabilities. It is not expressed in a percent, so it is not expressed in a percent. The video quality is low. Oh, let's see. What about there? 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 It is the faint pen. What about there? Is it far much better? Is it far much better? It is better. You can see you're saying it's okay. It is better. So we're having to say in this case, for this ratio, you don't express it in a percentage like the previous ones you've seen under profitability. So for profitability ones, in this case, you express them in what you call what a percentage. But these ones, this particular one, current ratio here, you don't actually express it in a percentage. What you do, you go to the balance sheet, you compare your current assets and you compare what your current liabilities. So when you compare the two, it will be able to indicate whether in this case, your current assets are quite adequate enough to cover your current liabilities. Remember, in this case, under current assets, you'll have items such as maybe inventory. You'll have items such as maybe in this case, cash at hand, cash at bank. You'll have in this case, items such as in this case, maybe what receivables. So, you know, for the receivables, you can be able to convert them into cash. Because when you collect the money from the receivables, you'll be converting them into cash. Cash at hand and cash at bank is the money that you already have. It is the money that you already have in the bank. It is the money that you already have in the bank. It is the money that you already have in the bank. So it means in this case, you are looking at how effective will you be able to, in this case, utilize these current assets to cover your current liabilities, to cover your current what liabilities. That we're having to talk about in this case, what, how liquid are you? How liquid are you? How liquid are you? So maybe you can just be able to briefly write an explanation here before we look at now the next one, which is quick ratio. So it indicates the number of times current liabilities can be paid out by the current assets. So it indicates It indicates the number of times the current liabilities, the number of times the current liabilities can be paid out, the number of times the current liabilities can be paid out by the current assets, So how many times can your current assets cover your current liabilities? The most recommended or ideal ratio is normally 2 to 1. So if you're operating between 2 to 1, then that is okay. So if your current assets are like double your current liabilities, then that is a bit quite okay. So 2 to 1 is the most ideal ratio you should be able to operate within, so that you can be able to cover your current liabilities. Then in this case, you have quick ratio. Quick ratio, sometimes it is referred to as acid test ratio. So we can have in this case what we refer to as quick ratio, or what we refer to as acid test ratio, quick ratio, or what we refer to as acid test ratio. So in this case, this one, you'll be able to take, now it's just the same. You take the current assets, you minus, in this case, inventory or stock. You minus inventory or stock, inventory. Then in this case, you divide by the current liabilities. It is known as a quick ratio because, the quick ratio or the acid test ratio, because now in this case, inventory, you cannot quickly convert it into cash. It is not easy to quickly convert inventory into cash. But in this case, the remaining assets, probably you can be able to convert them into cash very quickly, because you are saying in this case, under in this case, the current assets, we can have receivables. Receivables, you can at least call them. You call them, tell them, debtors, pay me my money. That is already money you have, is only that you haven't been paid. So it is easy to get it. Compared to, in this case, the items you have on shelf that you haven't sold, you never know. Either a customer will come or he won't come. So these ones are not actually quite easy to convert them into cash immediately compared to the others. So in this case, you only consider those items that you'll be able to convert them into cash very quickly as current assets. You compare with your current liabilities. So it means what is remaining here in the current assets will be, once you minus this one, it will be, for example, receivables, cash at hand, cash at bank. So in this case, you compare with your current liabilities, and that's why we call it quick. How quickly, in this case, can you be able to settle your current liabilities? So the ideal ratio is normally 1 to 1. So if you're operating within 1 to 1, it is okay. It is actually okay. So in this case, you can be able to write something briefly about it. So what does it indicate actually? It indicates the ability. Of the company. It indicates the ability of the company to meet its current liabilities, from its most liquid current assets. It indicates the ability of the company to meet its current liabilities, from its most liquid current assets, which I've already been able to explain. The ones that you can easily be able to convert into cash. So like receivables, cash at hand, you already have it. Cash at bank, you already have it. So those ones are already there. So you can easily convert them. So those ones you compare with your current liabilities. So you know how liquid you are as a company, to be able to know how liquid you are as a company. Then the last one in this case is what we refer to as cash ratio. The last one in this case under this category is what we refer to as cash ratio. Cash ratio is what we refer to as cash ratio. The last one under this category is what we refer to as cash ratio. So that is number 3. Under liquidity ratios, you can put the last one, in this case, what we refer to as cash ratio. So the cash ratio. The cash ratio. So for the cash ratio, in this case, you take cash and cash equivalents, cash and cash equivalents, you divide by, in this case, the current liabilities. You divide by the current liabilities. So of course, for cash, when they talk about cash here, they simply mean what you have in terms of cash at hand and what you have in terms of cash in your bank account. So that is cash here. When they talk about cash equivalents, it is what is equivalent to cash, but you don't have it at that point in time. It can be, for example, in this case, you've put your money into a fixed deposit account, or you put your money into what? Treasury bills, or you put your money into what? Treasury bonds. It is, of course, your money, is only that in this case, you don't have it at that point in time. So it is a cash equivalent. It is an asset that is equivalent to cash, because you can be able to sell that bond and you get cash. You can sell that treasury bill and you get cash. You can, in this case, maybe do what? Redeem that FD account and you get the cash. So that's what we refer to as what? Cash equivalents. Cash equivalents. So that's what we refer to as what? Cash equivalents. So it's the cash you have and any other asset that is actually equivalent to cash, only that at that point in time, you might not actually be having it at hand, but you can easily convert it into what? Into cash. So that is what you end up having to compare with what? With your current liabilities. And of course, you'll be able to know how liquid are you. So how much money are you having immediately? In any case, these liabilities fall due at once. Can you be able to settle them? So you need to compare, in this case, with your cash and cash equivalents. Then in this case, you do what? You'll be getting what we call what? A cash ratio. You'll likely be getting what we call what? A cash ratio. A cash ratio. So that is what happens there. So you can be able to write something briefly about it, just briefly about it before we start looking at the next category. You can say it indicates the ability of the company. It indicates the ability of the company. It indicates the ability of the company to meet current liabilities. To meet current liabilities from cash, to meet current liabilities from cash, to meet current liabilities from cash and short-term marketable securities, and short-term marketable securities, and short-term marketable securities, e.g. treasury bills or bonds, e.g. treasury bills or bonds. So that is what I'm calling cash equivalents, e.g. treasury bills or bonds, treasury bills or bonds, treasury bills or bonds, treasury bills or bonds. So that is now in this case what we call what? Liquidity ratios. Liquidity. How liquid are you? How liquid are you? How liquid are you? Then in this case we have category number 3. You can go to category number 3. So category number 3 is what we refer to as gearing ratio. Gearing ratio or leverage ratio. So gearing here, when you talk about in this case a highly geared company. A highly geared company is one that in this case is utilizing more of debt in financing its activities. It doesn't utilize more of, in this case, what? Capital, but it is utilizing more of what we're calling what? Debt in terms of what? Financing its business activities. Remember, in the company, in this case, there can be the source of capital you are talking about. You are selling your shares, you're getting equity. Or there can be that source of capital where in this case, you are raising what we call debt capital. So it means that in this case, in a highly geared firm, it means that the capital component is more of made of debt in terms of borrowing, other than in this case, what? Maybe equity. So when you talk about the gearing ratios here, they are looking at that perspective in terms of you raising capital. Where have you ended up having to dwell more, and how maybe in this case effective are you utilizing maybe what? Your debt capital, or what you've borrowed as what? As capital. So that's in this case we refer to it as what? We refer to them as what? Gearing ratios. We refer to them as gearing ratios. So number three category here, we can be able to talk about gearing ratios. Gearing ratios. Gearing ratios. So the classification classification, and write classification, and of course the formula. So you put those two columns, the classification, and of course the formula. So the first one in this case, we're going to look at is what we call debt to equity ratio. So number one, we refer to it as debt to equity ratio. So we refer to debt to equity ratios. What is the formula? So in this case, you take long-term debts, you divide by equity. So in the formula in this case, you take long-term debt, you divide by equity, then you multiply by 100%. You multiply by 100%. So long-term debt, you divide by equity, you multiply by 100%. You multiply by 100%. So you're simply just basically comparing you as a company, if you have borrowed in terms of capital, to what extent have you been able to do so in comparison to what you're calling the equity? Because in this case, the equity here, it is what you've raised as capital after you've sold shares. So these are the shareholders' funds when you compare the two. When you compare the two. So that is in this case what we refer to as what? Debt to equity ratio. So you can just briefly say it indicates the amount of long-term debt. 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 The amount of long-term debt in comparison to equity. It indicates the amount of long-term debt in comparison to equity. In comparison to equity investments. In comparison to equity investments. So that is what the debt to equity ratio. It indicates the amount of long-term debt in comparison to equity investments in the company. So number two, we can look at another one, another gearing ratio. In this case, we can look at the debt ratio. We can look at now in this case the debt ratio. So we can look at the debt. The debt ratio. We can look at the debt ratio. So for the debt ratio here, what is the formula? You take, in this case, for the debt ratio, you take the total. The formula is total liabilities. Total liabilities. You divide by total assets. You divide by total assets. Then you multiply by 100%. 100%. So this total liabilities is what you are liable. To pay. So you divide by your total assets, then you multiply by 100%. You multiply by 100%. So what does it indicate? It actually indicates the ability of the company's assets to cover the total liabilities. It indicates the ability. You can just write briefly something about it. Why would you end up having to compute this ratio? Maybe you're a financial analyst. Why would you end up having to compute this ratio? It will indicate to you, in this case, you can be able to write, it indicates the ability of the total assets of the company. It indicates the ability of the total assets of the company to cover up the total liabilities. It indicates the ability of the total assets of the company to cover up the total liabilities, It indicates the ability of the company's total assets to cover up the total liabilities, So remember, they're the ones that can be sold to cover up these total liabilities. Then we can look at another one, interest cover ratio. So number 3, interest cover. We call it interest cover ratio. Interest cover ratio. Or sometimes we normally refer to it as times interest earning ratio, times interest earning ratio, times interest earning ratio. So what is the formula? What is the formula for this one? So we're just looking at, will we be able to cover, just from the word interest cover, will we be able to cover the interest or the finance cost in the company? Remember, in this case, if you are borrowing, you know, when you borrow, you'll be charged interest. You'll be charged interest. So when you look at the interest cover ratio here, we are really trying to find out, us as a company, we've of course been charged this interest, but will we be able to cover it? Will we be able to cover it? So it means in this case, to get the interest cover ratio, you'll be able to, in this case, take the EBIT. You'll take the EBIT. You'll take the EBIT. So this is the formula. 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 EBIT. You divide by, in this case, interest expenses. Interest expenses. Interest expenses. You divide by the interest expenses. You divide by the interest expenses. So this one you don't multiply by 100%. So we're just trying to find out the interest you are having to pay when you borrow. How many times is it going into the earnings before interest and tax? Remember, in this case, if you are doing your computation here, it means that in your income statement, your income statement will likely look like this, Karen Paul. It will look like this. You'll have earnings before interest and tax. You'll have a figure there. Then in this case, you'll put what? Interest. You'll deduct interest. You put a figure there. You deduct interest. So what you get here is earnings after interest. So earnings before, you'll get earnings before tax. Then in this case, you'll put what? Tax. Then in this case, you'll get your earnings after tax. So like that. So that is how the income statement is presented. So the earnings after tax is the ones you can be able to now pay dividends. So it means we are basically comparing these two figures. We want to know, in this case, what you've gotten as the operating profits here, because the other items up here, before you go to the EBIT. What you got in this case as the operating profits here, which you are referring to as the earnings you have as a company, before you deduct interest and tax, because it is earning before interest and tax. So the interest and tax. So we want to know whether these earnings will be able to cover this interest. So we'll see when you do this particular kind of a ratio, you'll know here, for example, in this case, if you have interest of 10 million, and here you have, in this case, earnings before interest and tax of 100 million, it means that these earnings can be able to cover the interest 10 times. They can be able to cover the interest you've incurred as a company 10 times. 10 times. So that's why in this case, we'll end up having to do what? Compute the interest cover ratio, or the times interest earning ratio. So how many times will the earnings before interest and tax cover up what? The interest. Cover up the interest. So because when you borrow, told you gearing is all about having to borrow. So we're talking about, to what extent have you been able to borrow? So how are you having to be affected in terms of having been able to borrow? Or finance, in this case, maybe what? Your business activities as a company through borrowing. So that is why in this case, we can end up having to compute that ratio. So it indicates the number of times interest expense can be paid from operating profits. So that is very simple. It indicates the number of times interest expense can be paid from operating profits. Can be paid from operating profits. It indicates the number of times interest can be paid from operating profits. From operating profits. So from operating profits. So I think we can look at the last one. So number 4, the last one, number 4 under gearing ratios. The last one, number 4 under gearing ratios. The last one, number 4 under gearing ratios. So you have in this case fixed charge ratio. So number 4, fixed charge ratio. So fixed charge ratio, fixed charge ratio. So what is the formula? You take fixed return capital. So fixed return capital, fixed return you divide by total capital. You divide by total capital. You divide by total capital. Then you multiply by 100%. So when you talk about fixed return capital, it is that capital you've been able to raise that has a fixed return. For example, in this case, what preference share capital, it can have a fixed return, whereby the dividends that will likely be paid on this kind of capital will be very, very fixed, will likely be very fixed. So when you talk about a fixed return capital, is one that in this case, the return on that kind of a capital is fixed. You know, for ordinary share capital, the return is not fixed because the return to the shareholders in terms of dividends to ordinary shareholders will just be dependent upon as to how much the company has made as profits. So it is not fixed in any way. But now, when we take that component of the capital that has a fixed return, then we divide by the total capital, then we'll be getting the fixed charge ratio, the fixed charge ratio, the fixed charge ratio. So that is the formula. So what does it indicate? Just as I've been able to explain, it indicates the proportion of the total capital. 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 It indicates the proportion of the total capital, which has a fixed rate of return, which has a fixed rate of return, which has a fixed rate of return in relation to the total capital. It indicates the proportion of the total capital, which has a fixed rate of return in relation to the total capital, in relation to the total capital, in relation to the total capital. So those are what we refer to as what? As the gearing ratios, the gearing ratios, the gearing ratios. So you can now in this case look at what we refer to as what? Number 4, category number 4, activity ratios, activity ratios. Number 4, another category is what we refer to as activity ratios, activity ratios. Activity ratios. We can look at activity ratios, activity ratios, or sometimes we can refer to them as efficiency. There's a number of names: efficiency, efficiency. Maybe you can refer to them as asset utilization ratios. So they have a number of the categories can be named like that. So this category can be named as activity efficiency. How efficient are you utilizing your assets, or the asset utilization ratio? So there are a number of ratios here that will be able to look into how effectively you're utilizing your resources. How effectively you're utilizing your resources. So in this case, we have stock or inventory turnover ratio. So we have inventory turnover ratio, inventory turnover ratio. So just from the word turnover, so turnover. So this one is actually looking at how quickly or how effective are you turning over your inventory. So when you bring in inventory, you've purchased goods you want to sell. So how quickly are you able to sell them? So in this case, how long do they end up having to stay on your shelf before you sell them, before you end up having to sell them? So how effective in this case are you turning over, in this case, what? Your inventory. Are you turning over your inventory? And of course, in this case, the formula will be the cost of goods sold, the cost of goods sold, the cost of goods sold, you divide by the average inventory, average inventory. You divide by the average inventory. The average inventory. You divide by the average inventory. So, so the cost of goods sold, you know how you get it. You take opening stock plus purchases plus any carriage inwards, you minus closing stock, you'll get the cost of goods sold. You'll be able to get the cost of goods sold. The average inventory, in the question, if they have given you opening stock and closing stock, you add the two, you divide by 2. Hope you are getting the point. You have to be keen to what I'm having to say here. I'm having to say cost of goods sold, I know you know the formula. In this case, you do normally do what? Opening stock plus purchases minus closing stock, like that. The average inventory, you will take, if they have given you in the question, the opening stock and the closing stock, you add the 2, then you divide by 2. You divide by 2. But if you haven't been given, you just take the inventory figure. Let's say in this case, you've been given items or elements of a financial statement of the year, maybe 2024. So they have just given you a figure of inventory, in this case, in the balance sheet. But you don't know the opening stock. You assume that as the average inventory. So in a question where you haven't been given opening and closing inventory, you assume what you've been given as a single figure for inventory as the average inventory. But if you have been given the opening and closing inventory or closing stock, then in this case, you do what? You divide by 2. You divide by 2. So for the interest cover ratio, we are not multiplying by 100. Sour Daniel, we are not multiplying. We are looking at number of times. For number of times, you can't actually put it in percentage. So you just say 10 times. So we just say here 10 times. So when you get your answer, you'll say 10 times. When you get your answer, you'll say 10 times. So that is a question that was asked by Daniel there. So just say 10 times. So hope you are together. Hope you are together. So we've been able to say that is how you get, in this case, this particular ratio. So what does it indicate? It indicates the frequency with which stock is converted into sales. So how quickly are you turning over? It indicates the frequency with which stock is converted into sales. It indicates the frequency with which stock is converted into sales. It indicates the frequency with which stock is converted into sales. So how quickly are you converting your purchases or stocks into sales? You compute, in this case, what? The inventory turnover ratio. Inventory turnover ratio. Then in this case, we have receivables turnover ratio or debtors turnover ratio. Receivables turnover ratio. Receivables turnover ratio. So this one, you will take the credit sales. You will take the credit sales. Credit sales. You divide by the average debtors. You divide by the average debtors. You take the credit sales. You divide by the average debtors. You divide by the average debtors. You divide by the average debtors. So what does it indicate? It indicates the frequency with which customers buy on credit. It indicates the frequency with which customers buy on credit. It indicates the frequency with which customers will buy on credit, or they'll become receivables of the company. The frequency with which customers buy on credit, then that is what it indicates. You can write that. It indicates the frequency with which customers buy on credit. Buy on credit. Buy on credit. Then number 3, now we have at the other end, payables turnover ratio. So payables turnover ratio. So payables will arise when you do what? You purchase on credit. So it means in this case, for this formula, we'll take credit purchases. We'll take credit purchases. We'll take credit purchases. We divide by, in this case, what? The average creditors, or in this case, the average payables. So in this case, we divide by the average creditors. Average creditors. Remember, payables arise. Payables are same as what? Creditors. Receivables are same as what? Debtors. So payables are same as what? Creditors. So this one will arise when you purchase on credit. So in this case, we'll take the credit purchases, you divide by the average creditors. Average creditors. So what does it indicate? It indicates the frequency of purchase of items. It indicates the frequency of purchase, of items on credit, or purchase of inventory on credit. It indicates the frequency of purchase of inventory on credit. It indicates the frequency of purchase of inventory on credit, 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 of inventory on credit. Then from these three ratios, then you can just be able to continue. Number 4, now we can get what we call number of days from these inventories, number of days from this particular ratio, sorry. So number 4, you can just continue with the table. We have the classification. Just continue with the table. We have the classification. And of course, now in this case, we have, what? The formula. We have the formula. So now we can, in this case, get another ratio that is related to this one. We refer to it as what? Inventory holding period. Inventory holding period. Holding period. Inventory holding period. So how long will you hold an inventory item before you sell? On average, how long will you hold an inventory item before you sell? So in this case, there are two formulas that you can be able to use. You can either take the number of days in a year, then you divide by, in this case, by this ratio, inventory turnover ratio. You divide by inventory turnover. You divide by the inventory turnover ratio, or the stock turnover ratio. So you divide by that ratio. Alternatively, so I can see you're not seeing that end. Yeah, so like that. So in this case, you can take inventory holding period. You can be able to take number of days in a year, which is normally how many days? So I can see you asking about average debtors or average creditors. Just pick the figure. Of debtors. Pick the figure of debtors in the statement of financial position. Sawa. Just pick the figure of debtors in the statement of financial position, or creditors in the statement of financial position. Of course, now in this case, it will be indicated as what? As payables. Sawa. Just pick the figure of trade payables in the statement of financial position, or trade receivables in the statement of financial position. Don't start looking for opening and closing. Sawa. Don't start looking for opening and closing. Sawa, Joseph. Just pick the figure in the statement of financial position as it is. Don't start looking for the opening and closing. Hapo tu kwa average inventory, hapa ndio nimekuambia utaangalia. Kama umepewa, ndio uta add alafu divide. Kama hujapewa, just pick directly. So this one you can be able to look what is the opening and what is the closing. This one, don't look what is the opening. Don't start looking for them. Just pick the figures as they are in the statement of financial position. So hope that is clear. So in this case, for this one, there are two formulas for inventory holding period, just from the way it is named. So how long do you take to hold your inventory? How long do you take to hold what? Your inventory. So you'll take the number of days in the year, you divide by how frequently were you turning your inventory. And of course, in this case, you'll be able to get those number of days. Averagely, you'll be able to get averagely how many days does it take for you to turn your inventory. Alternatively, in this case, you can be able to just do this. Take in this case, average stock. You take average stock or average inventory. You divide by, now you reverse this formula. You take average inventory. In this case, you divide by cost of goods sold. You multiply by 365 days. you multiply by 365 days. Ideally, what has happened, it is we've reversed this formula. So this one has gone up, this one has gone down. Then in this case, you do what? You multiply by 365. It's just the same formula with this one. It's just the same formula with this one. Actually, if you do what you call in mathematics, what you call expansion. In mathematics, you are learning about what? How you expand a formula. When you expand this formula, you get this one. So you can do that. So average stock, you divide by cost of goods sold, you multiply by 365, you'll be able to get the same answer. The same answer. Or if you had already computed this ratio, just pick the figure here. Number of days, 365, you divide by this ratio here, you'll be able to get the inventory holding period. But what I've given you as an idea, you reverse this formula. This one goes up, this one goes down, then you multiply by 365. It's just the same as this one. When you do expansion in mathematics, you'll get this one. You'll get this one. So that's how you get, in this case, what? The inventory holding period. So there's another one, in this case, in relation now to this one, receivables turnover ratio. There's what we refer to as what? Receivables collection period. Receivables collection period. So averagely, how long does it take for you to collect from your debtors? So kuna wale ni kichwa ngumu, kuna wale ni kizungumkuti. So lazima wapigie wanakula time. So in this case, you want to know, like, how many days will it take me if I sell today on credit to a debtor? How long averagely does it normally take for me to collect this money? So when you do this ratio, it will give you like averagely how many days it will take for you to collect from your debtors. So in this case, you take the number of days, in a year, you divide by this ratio. So hapa tulifanya to the same thing. So number of days in a year tukadivide na hii ratio. So ukikuja hapa pia ukitaka kujua receivables collection period, unachukua the number of days, you take the number of days in a year, number of days in a year, you divide by, in this case, the receivables turnover ratio, or receivables turnover ratio, or the debtors turnover ratio. So receivables turnover ratio, or the debtors turnover ratio. You divide by the debtors turnover ratio. Or, in this case, or, we have an or there. You do the same thing. You reverse this formula. Average debtors over credit sales, you multiply by 365. Unaona vile tu reverse hii ingine hapa. Unaona hii tulipindua. Tukapeleka hii huku. Tukapeleka hii chini, ndio multiply na 365. So same case here. Unakuja unapindua hii, unapeleka hii huku, hii unaleta hapo na multiply by 365. It's just the same formula with this one. Ideally, if you do the expansion, like I'm telling you in mathematics, you'll get what I'm having to say. So in this case, you can put an or there. Then you say, now what happens? You can continue. Here. You can continue here. There's no problem. You can continue here. There's no problem. So or, there's our or there. In this case, you're having to say you'll be able to take now. So the average debtors, you'll take the average debtors or average receivables, average debtors, you divide by, in this case, the credit sales, you divide by the credit sales. Then you multiply by 365 days. So days. So these answers are actually in days. So when you get them, you put them in days because you're looking at the period. Looking at the period. Then number 6, there's another one related to this one. So payables, it is known as what? Payables payment period. So payables. So it is known as payables payment period. So payables, how long does it take for you to pay your creditors? Averagely, payables payment period. Payables payment period. Of course, for now, you've already known the drill. You take what? Number of days in a year. Number of days in a year. You know the drill now. Joseph. Number of days in a year. You divide by this ratio. The payables turnover. You divide by the payables. You know now the drill. The payables turnover. Or what do you do? You reverse. Average creditors over credit purchases multiply by 3 65. So we can have in this case, or, we can have or, we can have or in this case, you know now the drill, what is happening, you know now the drill, we reverse these ones. So or, in this case, average, in this case, average creditors, or average creditors, you divide by credit purchases, multiply by 365 days. So the answer will actually also be in days. It will be able to just show you averagely how long does it take for you to pay if you've purchased items on credit. It will tell you like maybe average will normally take 37 days to pay your creditors when you purchased items on what? On credit. So those are the formulas. So it means once you know the first three, then for the period or number of days, you can just be able to remember them very fast, as the way I've been able to show you, So those are, in this case, those ones related to what? Purchases on credit. Those ones related to, in this case, sales on credit. And of course, now in this case, what? Inventory turnover. So we can go to the number 7. Hope you've been able to write this one already. We can go to number 7. We can go to number 7, so that we can wind up with the category number 5. We can go to number 7 and 8. Then we go to category number 5, which is the final categorization of these ratios, So number 7. So number 7 in this case, we can have fixed asset turnover ratio. So fixed asset turnover ratio. Fixed asset turnover ratio. So there it is, okay. Fixed asset turnover ratio. So this one, you'll be able to take now, in this case, the sales. You take the sales over the fixed assets, sales over the fixed what? Assets, total fixed assets. Then number 8, which is the last one. So total assets, it will be total assets turnover ratio. So it's just the same as this one, but now you take the total assets. So it will be sales over the total assets. It will be sales over the total assets. So like that. So those are the formulas you can be able to use there. You can actually be able to use there. So you can now go to the very, very final category. Very final category of these classifications. We can now have, in this case, what we call valuation ratios. You can now go to the very, very final category, what we refer to as the valuation ratios. So hope you are through with that. So are you through with the writing so that I rub? Are you through, Joseph? I can see Elikana says yes. Yeah, I can see you are saying yes, you are through. So now we can go to the very, very final category of ratios, so that maybe we can see whether we can look at an illustration of what will happen in the past papers. We can look at an illustration from the past papers. So now in this case, you have what we call investor or valuation ratio. So that is category number 5. Investor or valuation ratios. Investor or valuation ratios. So just from the term investor or valuation, that's simply those ratios that an investor can be able to look at and be able to determine, can I be able to invest in this company or not? So these ratios majorly focus on what is the investor having to earn from the company. What is the investor having to earn from the company? And of course, they are derived in connection to how the company is actually valued. Is it a highly valued company? For me to decide that in this case, I'm going to, in this case, do what? Invest. So he'll focus in this case on looking what are the earnings I'm getting, how valuable is actually the company. So the ratios can be able to show the level of value of this company before an investor ends up having to do what? Invest. So there are those ratios, like in this case, someone intending to invest in a company will be so much keen about how they are behaving before he can end up having to make what? The investment. He can actually end up having to make what? The investment. So we can look at how they can be classified. So the classifications and of course the formulas. Classifications, then we can have the formulas. So the formulas, we can have the formulas. The classification, but of course, now in this case, what the formula. So the first one in this case is earnings per share. Earnings per share. Earnings per share. Per share. Sometimes it is normally known as what? EPS. EPS. What are the earnings you are getting for each and every share you've acquired or purchased or own in that company? So in this case, you'll be able to take the earnings attributable to ordinary shareholders. So earnings, you will take the earnings to ordinary shareholders. You will take the earnings to ordinary shareholders. You will take the earnings to ordinary shareholders. Earnings to ordinary, or sometimes you say earnings attributable to ordinary shareholders. You can just be able to say earnings to ordinary shareholders. You divide by the number of ordinary shares. You divide by the number of ordinary shares. Number of ordinary shares fully issued and paid. You divide by the number of ordinary shares fully issued and paid. So you take the earnings to ordinary shareholders. You divide by the number of ordinary shares, number of ordinary shares fully issued and paid. Fully issued and paid. Fully issued and paid. So that's why you end up having to get this one. Then in this case, number 2, we have what we refer to as what? Dividend cover ratio. Dividend cover ratio. Dividend cover ratio. Just from the word dividend cover. So what you've earned, will we really be able to cover the dividend? What you've earned, will we really be able to cover the dividend? And then in this case, you take the total dividends declared, and paid. So the formula, total dividends declared. You take the total dividends declared and paid. Total dividends declared and paid. Then in this case, you divide by, so total dividends declared and paid. Then in this case, you divide by the number of ordinary shares. Number of ordinary. You divide by the number of ordinary shares. You divide by the number of ordinary shares. Number of ordinary shares. Number of ordinary shares. Supposed to not dividend cover, but dividend per share, sorry. Supposed to be dividend, you can just correct that. It is not dividend cover, but dividend per share. So, but we'll see dividend cover later. So it's dividend per share, you can correct. Dividend per share. Not dividend cover, but dividend per share. So dividend per share, the total dividends declared and paid, you divide by the number of shares. So you want to know how much has actually been paid for each and every share you've acquired or you own in the company. So you'll take what has actually been paid as dividends, you divide by the number of ordinary shares. You divide by the number of ordinary shares. Then in number 3, we have what we call earnings yield. Earnings yield. We have what we refer to as earnings yield. Earnings yield. Earnings yield. So for the earnings yield, the formula will be earnings per share. So earnings, sometimes we refer to it as EY. It will be earnings per share you divide by market price per share. Sorry, you divide by market price per share. Market price per share, you multiply by 100%. It is a yield. So earnings yield, it is earnings per share. You divide by the market price per share. You divide by the market price per share. You divide by the market price per share. Market price per share. Then you can have also, in this case, apart from earnings yield, you can have what we call dividend yield. So dividend yield, you'll take dividends per share over market price per share. So for the earnings yield, you'll take the EPS, you divide by MPS. But also you can be able to have what we call dividend yield. So dividend yield, you take the DPS, because this is now the DPS. So this one you can put in brackets. Sometimes normally you will see somewhere they have indicated DPS. This one, DPS. So you're having to say, in this case, for the earnings yield, you take this one, EPS, you divide by the market price per share. For the dividend yield, which is number 4 now, for the dividend yield, you take the DPS over MPS. So in this case, you can have number 4. So dividend yield. So for the dividend yield, you'll take now this one, DPS over MPS. It will actually be dividend per share over MPS, market price per share. You multiply by 100%. You multiply by 100%. So that is the dividend yield. That's the dividend yield. Then we can have, in this case, dividend payout ratio. So number 5, dividend payout ratio. So dividend payout ratio. So how do you get the dividend payout ratio? Dividend payout ratio. Dividend payout ratio. So for the dividend payout ratio, then in this case, it is DPS over EPS. So DPS over EPS, or earnings per share, you multiply by 100%. So you take dividends per share, you divide by earnings per share, you multiply, in this case, by 100%. Then what I was talking about, the dividend cover ratio. So now we can look at now the dividend cover ratio. Dividend cover ratio. So this one is EPS over DPS. EPS over DPS over EPS over earnings per share. Earnings per share over DPS. Earnings per share divided by dividends per share. Then number 7, it is price earnings ratio. Price earnings ratio. Family known as the PE ratio. PE ratio. So for the PE ratio, you take the market price per share, you divide by the earnings per share. So you take the market price per share, you divide it, in this case, by the earnings per share. You divide by the earnings per share. You divide by the earnings per share. You divide by the earnings per share. So the market price per share, you divide by the earnings per share. So you'll get the price earnings ratio. So it will be, sometimes they call it PE like this, PE ratio. So you take the MPS, you divide by the EPS. So the MPS, you divide by the EPS like that. So the MPS, you divide by the EPS. So the earnings per share, or the market price per share, you divide by the EPS. So those are some of the ratios that in this case can actually be computed, computed. So we can look at an illustration. Briefly. So try to open try to open December 2022, question number 4B. So once you are there, you can let me know. December 2022, question number 4B. December 2022, question number 4B. December 2022. December 2022, question number 4B. So are you there? Are you there? So confirm whether you've gotten the question so that we can try to look at it, either part 1, then part 2 you can try. So December 2022, question number 4B. So confirm whether you've gotten it. So there are past papers on the group description. You can go to your group description in the group, WhatsApp group. They are there. You can be able to get them. So Clayton, have you gotten them? Clayton, Diana, have you gotten them? Have you gotten the question? So confirm whether you've gotten the question. Karen Paul, have you gotten it? So I can see Kim says yes, 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 yes. So there's that question there. Maybe I can just be able to guide you. I do part 1, but we'll wind up with it on part 2. Part 2, as we also be looking at, so the question says, ratio analysis has over time, that is question number 4A, that is part A. Ratio analysis has over time proven to be useful financial tool for decision making. However, reliance on ratios for decision making has inherent limitations. Required, citing 6 limitations, justify the above statement. Justify the above what statement? So here they want us to, we talk about the advantages and disadvantages of having to utilize what? Ratios. The advantages and disadvantages of having to utilize, in this case, what? Ratios, or utilization of ratio analysis. So you can be able to write briefly, the advantages of ratio analysis. Advantages of ratio analysis. Before you look at the limitations, just write advantages of ratio analysis. Advantages of ratio analysis. So that is part A of the question. So advantages of ratio analysis. Advantages of ratio analysis. Then also you can be able to look at disadvantages. But first of all, let's start with the advantages. Why is it important, or what do ratio analysis provide as an advantage? Number 1, they are used to determine the ability of the company. They are used to determine the ability of the company to meet its financial obligations. They are used to determine the ability of the company to meet its financial obligations, i.e. liquidity ratios, i.e. liquidity ratios. That is one of the advantages. Then number 2, they indicate the extent to which the company has borrowed funds. They indicate the extent to which a company has borrowed funds. They indicate the extent to which a company has borrowed funds, i.e. gearing ratios, i.e. gearing ratios, i.e. gearing ratios. Then number 3, they can be used to determine the value of a company. They can be used to determine the value of a company. They can be used to determine the value of a company, i.e. valuation ratios, i.e. valuation ratios. Then is it number 4, 5? Number 4. They can be used to compare the performance of a company over time. They can be used to compare the performance of a company over time. They can be used to compare the performance of a company over time. So that is another advantage. You can compare, for example, ratios for 2022, 2023, and it'll be able to tell you the performance. So in terms of, for example, profitability, you can look at the profitability ratios. So they can be used to compare the performance of a company over time. Then the next one, the next advantage, they can be used to compare the performance of a company with competitors. They can be used to compare the performance of a company with competitors. They can be used to compare the performance of a company with competitors. With competitors. With competitors. They can be used to measure the performance of a company to compare the performance of a company with competitors. With competitors. Then disadvantages. So that is what now the question wanted you to indicate. The disadvantages of ratio analysis. So disadvantages of ratio analysis. What are the disadvantages when you use ratio analysis in financial statement analysis? Number 1, so the disadvantages, it does not consider the fluctuation of values. It does not consider the fluctuation of values as a result of inflation. It does not consider fluctuation of values as a result of inflation. As a result of inflation. As a result of inflation. So it does not consider the fluctuation of values as a result of inflation. Then number two disadvantage, adoption of different accounting policies. Adoption of different accounting policies from one company to the other. Adoption of different accounting policies from one company to the other. From one company to the other. Can distort comparison. Can distort comparison. Can distort comparison. You won't be able to compare because companies are using different accounting policies. So they might not end up having to have like a similar format of presentation of financial statements. So even if you do the ratio analysis, you can't be able to use them to do the comparison. Then number 3, ratios fail to capture the qualitative aspect of company operations. Ratios fail to capture the qualitative aspect of company operations. So ratios fail to capture the qualitative aspect of company operations. For example, in this case, it doesn't consider the integrity of the management. It doesn't consider, for example, in this case, what the effectiveness or level of skills of the employees. It just looks at what the financial statements figures, and that's all. So the qualitative aspect is not actually considered. These figures that you're having to see, they were driven by maybe the integrity of the management, the performance of the management, because without performance, these figures would have been a bit different. So that qualitative aspect in terms of the quality of the management is not considered in ratio analysis because we just use what figures, as you've already been able to see. So it doesn't, in this case, capture the qualitative aspect of the company operations. So that is what another disadvantage. Another disadvantage. Then another disadvantage is the next one. The errors in the financial statements, the errors in the financial statements, the errors in the financial statements will automatically reflect, the errors in the financial statements will automatically reflect in the ratio analysis. The errors in the financial statements will automatically reflect in the ratio analysis. So if you have wrong figures in the financial statements, then your ratios will also be wrong. So the errors in the financial statements will automatically reflect in the ratio analysis. Then the next one, ratio analysis, another disadvantage. Ratio analysis does not consider the time value of money. Ratio analysis does not consider the time value of money. Ratio analysis does not consider the time value of money, the time value of money. So that is another what? Disadvantage. Disadvantage. Does not consider the time value of money. So those are part of the disadvantages of what? Of ratio analysis. So there's that part B. They want you to compute ratios in relation to shareholders, trade payables, and internal management. You can try that one. So then I think we'll be able to look at it tomorrow together in class as we wind up on the topic of analyzing financial statements. So that will likely mark the end of this particular topic. Is topic number 7. It is the end of it because we've done ratios, we've done common size, we've done comparative. So that will be the end of that topic. Then I think from tomorrow, we'll be able to look at another area. And I would like us to start looking at what we call income taxes. Income taxes is under topic number 1, under assets and liabilities. So that is what we'll look at tomorrow after we've been able to look at that illustration for ratio analysis. But you can try to attempt it by yourself. Part B of this one, part B of this one, part B of this one. So that is what we'll be able to look at. Any question you might be having, you can ask before we say hooray to our today's class. Before we say hooray to our today's class. Do we have a class on Saturdays? Oh, no. So the classes for this particular session happen on Tuesday, Thursday, and Friday, 6 p.m. 6 p.m. 6 p.m. So Monica, take note. These are the timings. So the one for Saturday is not for this class. It is for that other class. It is for that other class. Sawa Monica. So Tuesday 6 p.m., Thursday 6 p.m., Friday 6 p.m. It is known as the 6 p.m. only class. It is known as the 6 p.m. only class. It caters for those ones. You might be wondering why it was placed in the timetable. It caters for those ones who don't want to do the class at 8 p.m. It caters for those ones who want to concentrate on cooking after 8 p.m. or those ones who want to do what? To sleep from 8 p.m. So there are those who sleep early. So they don't want to do a class from 8 p.m. So it is known as the 6 p.m. only class. We also have early morning. So there are 3 sessions for FR. FR is a very special unit in the entire CPA at RCM. It has 3 sessions, early morning, 6 p.m. only, and evening. That is 8 p.m., 8 p.m. and Saturday. No any other unit in CPA has such kind of sessions. So it has 3 sessions. You can choose from whichever you want. It has different lecturers. So that's it. So let's end there. So let's meet tomorrow. We finalize on analyzing financial statements. Then we can do income taxes. I repeat the first 2 advantages. Or the one I said I'll compensate. So the one I said I'll compensate. So I'll communicate because Saturday I have a burial. So I'm going for a burial. That's why I missed the class on the class on Tuesday. So I'm in the committee. So that's why I missed the class. Saturday I have a barrier. So probably we won't have the class. So that's it. So, but for tomorrow, the one for tomorrow we'll have it. The one for tomorrow we'll have it. So Saturday I'll be having a burial. I'll be burying my in-law. So I won't be around. I won't be around. So I'll just inform you when we'll do the makeup. So we can end there. So let's catch up tomorrow. Let's catch up tomorrow.